Retirement phase starts around the age of 60 or 65. The retirement phase marks a transition from full-time work to relying on savings and investment for expenses. A stable income source is vital for a comfortable lifestyle during retirement, and many opt for fixed deposits due to their simplicity, fixed payouts, and convenience. Do you think FDs are enough to lead a comfortable post-retirement life? This video dwells into alternate investment strategies beyond fixed deposits to enhance the effective management of retirement corpus for a more comfortable post-retirement life. Let's begin. Welcome to holisticinvestment.in. Many retirees fall into the trap of opting for investment vehicles that promise predictable returns. Can these returns adequately cover expenses like food, healthcare, and leisure activities? The retirement corpus, which is the result of your hard work, needs to be managed carefully to ensure it lasts throughout your retirement. Which investment options can effectively achieve this objective? Let's analyze 4 distinct scenarios with illustration to gain a clearer understanding. Assumptions for the workings. Accumulated retirement corpus Rs 1 crore, retirement age 60 years, life expectancy 85 years, initial living expenses Rs 6 lakhs per annum, inflation 6% per annum, fixed interest rate 7% per annum, equity mutual fund CAGR 12% per annum, debt mutual fund CAGR 7% per annum. The tax liability is assumed as nil. Since under the new tax regime, a resident individual with taxable income up to Rs 7 lakh can avail of a rebate of Rs 25,000 or the amount of tax payable, whichever is lower. Scenario 1. Rs 1 crore in fixed deposit. Assume you invest a corpus of Rs 1 crore in a fixed deposit scheme and earn a regular income of 7%. This will earn you Rs 7 lakhs per annum. Assume you have an annual expenses of Rs 6 lakhs per annum and inflation is 6% per annum. You will be happy during the initial years as the annual income will cover your expenses. But your expectations are shattered down the lane because due to inflation, the expenses keep on rising, but on the other hand, your income is fixed. What does this teach us? Fixed deposit often fails to preserve the purchasing power of your funds. The hard fact is that you cannot combat inflation with fixed deposit in the long run. Next, scenario 2, Rs 1 crore in debt mutual fund systematic withdrawal plan. Systematic withdrawal plan allows investors to withdraw a fixed amount of money at regular intervals from their mutual fund investment. Let us assume Rs 1 crore is invested in a debt mutual fund. In SWP, you get the advantage of adjusting the withdrawal based on your needs. To meet your rising expenses, you can increase your annual withdrawal. If the annual income is not sufficient to meet your expenses, then your capital starts depleting. The deficit is funded by your capital. Here, from 5th year, the deficit gets adjusted by the debt opening balance. Though you get inflation adjusted income, your capital exhausts at the age of 80. What is the point in beating inflation if the corpus can't withstand till your lifetime? Debt mutual funds can withstand and combat inflation to some extent. Sustaining the corpus till your lifetime is the major hurdle here. So, this scenario neither suit retirees. Scenario 3. Equity 60, debt 40. 60 lakhs in equity mutual fund and 40 lakhs in debt mutual fund. You split your retirement corpus into 2 buckets. While the debt portion offers regular income, the equity portion can provide higher returns over the long term, helping to offset inflation and maintain purchasing power. 40% in any debt mutual funds offer a guaranteed return of around 7% per annum. Invest the balance 60% of the corpus in equity mutual funds, which can yield around 12% per annum. Though they are dynamic in the short term, the chance of capital appreciation is high in the long run. Debt portion allows you to withdraw in accordance to the rising expenses. Meanwhile, the equity portion appreciates in value. Whenever the debt portion is depleted, it is reimbursed from the equity portion. In this scenario, every 6 years, Rs 60 lakh is moved from equity to debt. This will fund your regular income needs. At the age of 78, the equity balance is fully shifted to debt. Under this scenario, your corpus outlives you. The splitting of funds between equity and debt and also the shifting of fund, that is rebalancing between equity and debt, can be designed based on your personal risk tolerance. The The given scenario is just an illustration. You can modify it based on your personal preferences. This investment strategy offers regular income, protects the purchasing power of income, and the corpus outlives you. The best option for retirees is a perfect mix of different assets adjusted regularly to match personal preferences as shown in the scenario. Scenario 4, rupees 1 crore in equity mutual fund. In the earlier scenario, equity mutual funds augmented your retirement income. The allocation of equity in the portfolio allows it to withstand inflation in the later years. In this scenario, the corpus is parked entirely in equity mutual fund. Unlike fixed income investments such as fixed deposit, equity do not guarantee the return of your initial investment. Equity markets are known for their volatility, which means that the value of your investment can fluctuate significantly over short periods. For illustrative purpose, the annual growth is assumed as 12% per annum. The table here depicts the equity growth over a long period. Despite the annual withdrawal, the growth is so rapid due to the compounding effect. Now let us work out the calculation with real-time NAV. For calculation purposes, we have chosen the Franklin India FlexiCap Fund. Your retirement corpus of rupees 1 crore is invested in Franklin India FlexiCap Fund. In the first year, you withdraw rupees 50,000 per month to manage the annual expenses of rupees 6 lakh. Thereafter, to combat inflation, the annual withdrawal is stepped up by 5%. The period of withdrawal starts from the year 1999 to 2023. The final maturity value after 25 years is rupees 92.35 crores. The CAGR for this scenario is 22.23%. Parking your entire retirement corpus in equity asset class can have several disadvantages, primarily related to the higher level of risk associated with equities. Following a market downturn, it may take a significant amount of time for equity markets to recover. A prolonged recovery period could impact your ability to meet your retirement income needs. While equities have the potential to outpace inflation over the long term, there is no guarantee of returns every year. The volatility of equity markets can cause psychological stress and anxiety, especially for retirees. Due to the higher level of risk, this scenario is not an advisable option. Moreover, practically, this is not a viable option. To conclude, fixed income instruments offer safety and stability, but they may not be the one-stop solution for your regular income, especially in environments of low interest rates. As a result, retirees may need to explore alternate investment strategies to maximize their income potential while managing risk effectively during retirement. To mitigate the risk, retirees need to diversify their investment portfolio across different asset classes, namely equities and fixed income. Diversification can help spread risk and reduce the impact of market fluctuations on your retirement corpus. The calculation part reveals that scenario 3 is the most suitable option for retirees where asset allocation and rebalancing strategies are employed. Retirees need to carefully assess their risk tolerance, income needs, and investment goals before pursuing any alternate investment strategy. Consulting with a financial advisor can provide personalized guidance and help you develop a retirement investment strategy that aligns with your risk tolerance and financial goals. A detailed blog post on this topic is available in our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.